Hello, I'm Greg Ninnis for interest.co.nz, and today I'm talking with Andrew Bruce, who's President of the Auckland Property Investors Association. Welcome, Andrew.
Thanks, Greg.
The property market is still very much in the news. We've had strong price growth coming through in Auckland, and also rents are starting to rise as well. That puts investors who already have a portfolio in a pretty good situation. They'll see the equity in their properties rising and their rental income's increasing too. And interest rates haven't been going up, so they're not facing those extra costs. How are most of them reacting to that? Are they tending to just take the extra money and let the equity appreciate? Or are a lot of them still in expansion mode and looking to add to their portfolios?
I think it really depends where you are in your portfolio. The people that are probably more developed into their portfolio, they may understand the market cycles a little bit better than people that are just wanting to get into the market right now.
Yeah.
So those people, I see that they're doing their repairs and maintenance.
These are the experienced
These
investors.
are the more experienced, more seasoned, more long-term investors, because investment is very, very different to speculation or development or trading.
Right.
But we all tend to get lumped into the one group,
Yes.
so to speak, by many parts of the media. But the investors that are in the long term, in there for the long term, because property investment is a long-term game.
Yeah.
They're doing their repairs and maintenance, and I know quite a few are going through, looking at the cycle. It's obviously going very well at the moment. Getting things revalued. The capital values just came out recently, but also getting registered valuations, getting things revalued, getting their flexi facilities ready with a view to what happens in the future. Now, I know late last year we were picking maybe interest rates certainly wouldn't be decreasing like they are at the moment. So it's hard to know what's going to be happening in the future. But yeah, just sort of securing in some of these deals that are on offer with the banks, and in a little bit of a sit and wait mode, because it is very hard to make something work from a cash flow point of view.
And that's because prices have risen so much, but rental income hasn't risen correspondingly at the same rate.
Correct.
So the cash flow isn't there to support it if you need a lot of debt to fund it.
Correct, because you've got to work back to a net return, not a gross return.
Okay.
A lot of people just work out a gross return being the rent times 52 weeks divided into a purchase price. But the reality is you've got costs over and above that. You've got rates, you've got insurance. If you're an apartment, you've got body corporate levies. There's repairs and maintenance. There's vacancy. So there are other costs, and obviously the biggest cost of all is interest. But the interest rates have been coming down, so that does make it easier.
Okay.
But yeah, for the people that I know that have got reasonable sized portfolios, they aren't really that keen to be buying extensively negatively geared properties.
Right.
Because you end up reaching a glass ceiling with the banks pretty quickly, particularly if you have a few properties, because the serviceability is generally what will slow down the larger investors. I suppose when I say larger, I mean people with 4, 5, 6 properties. Whereas if we look at people that are maybe newer to the market, they may not sort of follow the cycles quite so much. And once they're in a position that they've got some extra equity, whether it be in their property or they've come by some extra money for whatever reason, they tend to jump into the market when they're ready. And I know that was exactly our situation when we were started investing.
Yeah.
I didn't wait for a cycle. I didn't really know about the cycles. I just went into it.
Because you could afford to.
Because I could afford to, and because I was all fired up, ready to go. So that's the time to get into it.
So if people are looking at getting into the market now, they might be facing a situation where the gross rental yield on a property might be even just 5%, something like that. A net yield might be 4%. Do you think that's the sort of thing people could be looking at?
Oh,
yeah,
totally.
And how would they make that work? What sort of people are buying at those sorts of yields?
Well, I suppose it really depends on what you're looking at. Like, you know, people can be initially buying at those yields, but maybe there's an avenue to add some value to it. Maybe they're looking at trying to do some repairs and maintenance to the property. Maybe they try and convert a 2-bedroom into a 3-bedroom to add some extra rental and therefore get that gross and net return up. If you are more what I suppose call a like retail investor, just go in and pay pretty much what you have to pay, it does make it a very long, slow grind. And yeah, negative gearing isn't fun.
Right.
It isn't fun, and you know we've got record low interest rates at the moment. What happens in a couple of years' time if those move a little bit? That does make it tough.
And people could find themselves in a bind, particularly if at the same time the value of the property is going down, which would make the bank nervous as well.
Absolutely. And look, you know, these are market cycles. You know, we saw it in 2008, 9, 10, didn't we?
Yeah. So the same thing could happen all over again, and perhaps it's inevitable it will. We just don't know when and how severe that will be.
Absolutely. No one knows when, but we do know market cycles happen.
Okay.
It isn't a perfect world out there. It doesn't work how the economists say it's always going to work.
Yeah, sure.
And it's market driven, it's people driven, it's emotion driven, so therefore it doesn't go by the book.
Okay. One of the areas of the market where the yields are still a bit better and the cash flows will be better is commercial property. Are you seeing many investors start to look at commercial as opposed to residential to, get that better cash flow?
I'm not actively involved in the commercial. We do have a commercial property.
Yeah.
But I'm not actively networking with people in the commercial sector.
Okay.
It certainly can make sense, but it's a whole different ball game.
Right.
Rather than dealing with people like we are at a residential level, in terms of the tenants, it's really contractual based.
Yes.
And there's a whole different level of information that has to be provided to the banks, and there's all sorts of different criteria involved.
So you're not sort of getting the mum and dad type investors looking at buying a retail unit somewhere rather than a home unit up the road.
I haven't heard a lot of that. I'm sure it is happening. But the other thing is generally you have to put more equity into those as well. Your loan to value ratios can be considerably higher. So it does lend itself to people with a little bit more equity. And ability to actually get into that market.
So they're probably more experienced investors who are getting into that.
Most probably.
Okay. How do you see things continuing then going forward for property investors? Do you see them facing any major headwinds coming up?
Well, what I sort of see sometimes at this time of the market is people start going, well, unless we're looking from a speculative point of view in terms of buying with a short-term capital gain, for instance in Auckland, some people start going, well, I really am, I need this cash flow to make it work. So then they start looking, well, maybe Hamilton's an option, maybe Taurong's an option, maybe Rotorua. And Rotorua has a lot of rental properties with Auckland-based landlords. In fact, we own one down there as well. And we bought one at around about this time of the market cycle, last cycle, for this reason. For the cash flow reason.
Because you couldn't make it work in Auckland, but the prices were low enough relative to the rents down there that it stacked up as an investment.
Absolutely, because in the end you've really got to look at what are you doing this for? Are you doing it for capital gain, or are you doing it for sort of long-term, and I'm loath to say passive income because residential property management is anything but passive. But for a long-term income, and obviously the higher your net return, the harder your equity is working for you.
So everybody's looking at the monthly figures that come out with prices, and they're high, and everybody's getting excited about that. But there are still risks with that, and people need to be looking at that cash flow and being cautious.
There's risks with everything. There's risks absolutely with everything, but cash flow is, like in any business, cash flow is key. You need to have that cash flow coming through to pay the bills. If you're negatively geared and you're having to chip in X amount of dollars each week to make this work, and then all of a sudden the interest rates go up, and I'm not saying that they're going to go up in the next year or two. I don't know when they're going to go up, but at some stage they will go up. That is going to put the squeeze on. So something that works on today's interest rates with a 5 in front of it may not necessarily work quite so well if interest rates move half a percent or a percent.
Do you see the basic drivers in Auckland of supply and demand changing much in the near future?
Look, there's a lot of noise out there about how properties are being built in these special housing areas and this sort of carry on. It's still very hard to get things through.
Yeah.
It's still not a quick process, and it's still an expensive process. So, yes, there will be more houses built, but whether we're going to catch up with this 20,000 shortfall or whatever the number actually is, yes, there'll be a slight catch up. I don't see it getting to a neutral position in the next 2 or 3 years. Anyway. This is a very slow process. To build and create houses is not a fast process. So the building houses is actually the fast part of the process, to be honest with you.
Yeah, sure. So basically, the foundations that are holding up the market at the moment are not likely to go away anytime soon.
Well, I suspect if we turn it around the other way, if we had a 50,000 housing oversupply, we would be having a very different interview now.
Yeah, of course. Okay. Well, we might have to wait a few years to have that interview.
I think we might.
But thanks very much for joining us today on interest.co.nz.
No, thanks, Greg.